Barry, Morningstar's data shows that investors consistently underperform the very funds that they own. Why does this gap happen? What's going on there?
Well, Greg, it's something that's been going on for many, many years. And that is people tend to chase yesterday's winners, which inevitably hurts tomorrow's performance. So the way many screen for which funds they're going to buy, which managers they're going to hire, is based on 1 year, 3 year results, maybe 5 year results. And oftentimes the managers with the best results are oftentimes due to mean regress over the subsequent period.
And it's not about fees, right?
No, fees are an element in investing. If you want to hire an active manager, which we at Virtus think is an important factor for many people who want to mitigate risk along the way, fees are part of it. But really the whole issue is investor behavior drives outcomes far more than any other factor that you could think of, whether it's tax efficiency, cost, portfolio turnover. Everything is dwarfed by people's tendency to buy high and sell low.
So if an investor is shooting themselves in their own feet, how does an active manager with the help of an advisor change that?
Well, that's, as you said, with the help of an advisor. See, it takes a village, if you will, right? And a great advisor has to be looking out for the client's total portfolio. And that portfolio needs to be positioned for enough risk to achieve objectives over the long run, but not asking the investor to be somebody they're incapable of being. So it has to be kind of consistent with the client's investment personality. So a great investor, a great advisor with an excellent portfolio plan, then oftentimes they should be pairing, in our view, active management, differentiated active management with passive exposures to get a good combination going, right?
Let's just talk a little bit more about passive investing because, I've read a whole lot of Jack Bogle, and he seemed to think that passive investing is all you need. And for a while, a lot of people did as well.
Yeah, I think passive investing has a place in most people's portfolios, but people should know more than just what the cost is, right? There's the cost behind the fee, the lack of a fee. When you think about it, a passive investor is valuation agnostic, they're quality agnostic, you're straitjacketed into the most expensive stocks oftentimes, regardless of market conditions. And for risk-averse investors, and a majority of the money in mutual funds and ETFs are from people 60, 65 and above, who don't necessarily have the emotional ability to look at a 20, 30% decline as a temporary fluctuation or as a buying opportunity. So we think combining passive exposures with differentiated active, and by differentiated active, I mean managers that have given you smoother ride access to an asset class that you want exposure to, you can get a behaviorally aware portfolio, a portfolio that a real client may be able to stick with through thick and thin.
So, of course, every client is different, but on the whole, how would you mix an active and passive funds in a strategy right now?
Okay.
What would it look like?
What I would be screening for with active portfolio. Now, the backdrop. Equity valuations are historically elevated. Credit spreads are near historically tight. So you have to take, in my view, a bit of a cautious approach in your overall portfolio construction and focus on real diversification, not just the appearance of diversification. You want exposure to out-of-favor asset classes, some that are less expensive. And you want a manager that has been through multiple market cycles and has delivered good upside-downside capture ratios, meaning that they participate meaningfully on the upside, but they don't have to be heroes in the up markets, so long as they do relatively well in down markets by losing less than other managers and the benchmark they're competing against. If you can do that over market cycles, you end up with better returns with a smoother ride, the kind of ride that actual investors can stick with over the course of the cycle.
And then finally, we've been speaking a lot about, I guess, mutual funds and maybe ETFs. But what about private equity and a lot of these, I don't know, evergreen funds and things that are popping up now where people have a problem sometimes with the liquidity involved? How do you add that to a portfolio? Because a lot of people are adding private equity to portfolios.
So private investments offer an opportunity to get into some areas of the markets that you couldn't do in publicly listed securities. If you want to try to reach for that illiquidity premium, not every aspect of most people's portfolios has to be daily liquid. You have some, like just say you're putting together a retirement income portfolio. Maybe you want 75% of that daily liquid, maybe 25% of that you don't need access to for a few years. And you want to pursue higher yields, higher returns that are available sometimes more in the private markets. It's a great opportunity to expand your horizon to pursue better potential long-term returns. The liquidity risk thing is something that people just have to be cognizant of. They have to know that in many of these investments, they may not be able to get all of their money out precisely when they want it. It depends on sales levels and outflow levels and market conditions and dislocations. But if you are prepared to deal with that, you have an opportunity to further diversify your portfolio than you could otherwise do with publicly listed securities alone.
All right. Well, thanks for coming on and talking about it.
Thank you, Greg.